Welcome to the State of the Markets podcast and a happy 2025. I'm Paul Rodriguez of thinktrading.com.
I'm Tim Price of pricevaluepartners.com.
And we are very privileged to have Tony Deden.
Tony Deden, welcome to the show.
Thank you, sir. Good to be here.
So, first of all, for the benefit of people who don't know you, could you give us a potted biography, if you may?
How potted should it be?
As potted as you like.
Well, I'm in
potted or unpotted.
On my late 60s, I started doing this work in 1985 by advising a couple of families on a bond portfolio, sort of like you. And then somebody else came in and said, someone really actually prompted me to take on this responsibility of looking after the family of a person who had just died, left a widow and young children. And I became overwhelmed with the idea of what happens if they lose this capital. So that's how it started. And from 85 till roughly 2004, I looked after private portfolios for a few people. Some of them extremely rich, some of them not so, but that's all they had. And from 2001 up until now, I have been laboring on a company called Edelweiss Holdings, which is not a fund; it's a private holding company based in Jersey. And I no longer do private advisory work or anything like this. Just I've been working on this company's affairs. I don't write as much as I used to anymore, just for our shareholders. And I don't know what you know more about me than I do.
Your background is unconventional, isn't it? Because if I'm correct, you didn't work in what people would call traditional finance before you started out on this endeavor.
I never did. I worked as I studied mathematics and chemistry at the university. I worked as an acquisitions analyst for a private holding company in Houston, Texas. I lived there for nearly 25 years or so, but everything I've learned is from reading and practice. And frankly, Tim is I was merely motivated by fear of poverty or fear of doing something wrong than the idea of becoming rich and famous. And that still motivates me to this day. So that's more or less it. I cannot, other than, this is more or less it.
So you mentioned reading. Who for or practice? Who would you state were some of the stronger influences on your philosophy?
Well, as you know well, you read a lot and you become fascinated with this idea of value investing that most people speak about. And then I think that there have been two people in this work that have influenced me the most. One was a fellow named Richard Ellis, who is no longer, it's a very old American fund manager. And the other one was Jean-Marie Eveillard. But I became fascinated really early on, back in the early 90s, about economic phenomena, because as you were, of course, at the time, we were working with interest rates and credit risk and interest rate risk and duration and all that sort of stuff and currency issues. I wanted to understand more about money, what it was, what was an interest rate, why. I wanted to understand how the world operated. So I became interested in the economics of money. And I guess you can gauge my trajectory since then. I still am. But frankly, I think that one of the things that has made a big difference in my own life is that I saw failure as a way of understanding the factors that contributed to it. And the idea was not to lose. Um, I think there was Richard Ellis that said that the business of deploying your capital is sort of like the game of tennis, which is different than any other game. And that is, it's not how many goals you score, is
It's getting the ball back over the net.
how many errors you don't make.
Yeah.
It's about not making errors rather than winning goals. And so the idea of failure, and why did a company fail? For example, I remember many years ago in the United States when some bank would declare bankruptcy or somebody would take over something, or I saw the beginning of the end of Eastman Kodak, and you start thinking to yourself, why would such an incredible company fail? Xerox and digital equipment and you name it. So I sought to figure out exactly what were the components that contributed to such failure. That was really the beginning, and that gives you that helps you understand what not to do, perhaps.
And what did you find with that? What were the things that contributed to failure?
Well, largely hubris. In hindsight, I think failure comes from, well, it really depends. It's a human factor. I think that there was someone who said that I don't remember, but Tim would, I would rather invest in a mediocre company with great people than a great company with mediocre people. So I think the human element, in my view, has the largest factor in corporate failure. And frankly, that human element is one that you will not find in financial accounts. Ever.
Right.
Now, what is it that, I mean, years later, I think back in, well, say 10 years ago, maybe longer, I came across a company that had been around for 260 years in the same family. So I became interested in those factors that contributed to longevity. What were those factors? And so my life is just a series of learning, I suppose, probably from the errors of others. I've made my own, of course, but my own errors were always very small and insignificant in the scheme of things. But the avoidance of error and the focus on the aspects of on those things that are unmeasurable and unquantifiable have been a very large component of my own practice.
What was it about the financial system that you found to be erroneous to make you decide that you wanted to just focus on companies and people rather than watching the markets rise and fall, but in certain circumstances rising substantially over time? Because, for example, if you speak to an investment manager, certain investment managers, they'll just say, well, just over time, the S&P will make money. Just invest in the S&P 500. And that's a very simple way of approaching the market, or buy the S&P and hedge it with bonds. What was wrong with that strategy as far as you were concerned?
Well, you realize that in the investment industry, the investment industry has become really a very large business where people who are involved in it, they seek to satisfy the wishes of those they serve. And they do it with respect to performing as others do or better than others do, or et cetera. They seek to find an edge within the context of markets. And there's an old fellow who told me once, and I think that he was repeating something he was well known. He says, show me your customers and I'll tell you who you are. So every investment practice is rooted on the nature and needs of those people being served. what they expect, and the motivation of those doing the serving and their sentiment. Now, many years ago, I met a wonderful man who gave me the metaphor that at the time I found to be simplistic and perhaps pedantic. But he said that he says the financial markets are no different than a vegetable market. If you are a chef, you go to the vegetable market and you buy whatever you need to make that dinner tonight for your customers. What the market does on its own is of no consequence. All you're interested in is the quality that you want at the price you want. And if you don't find something today, you'll find it tomorrow. But the market itself is a means to your ends rather than a means to an end in itself. And so seeking to understand what the markets do, I think it's just perhaps not so interesting to me as it is perhaps for other people.
The core principles of how you invest are obviously, because of the way you came into the field. It wasn't that you went to university and that, well, you may have gone to university, but you went to work for an investment bank and then you learned that way. You learned practically what you had to do because you were given a responsibility and you wanted to execute that with the best way that you could. So from what I can understand, and you could correct me if I'm wrong, the people who seem to do the best in any subject tend to be the ones that work it out for themselves, and they're endlessly curious, and they're not motivated by copying what other people are doing. Would you say that was an approach that you took to your study of the markets?
Yes, I think that I remember back in 2002, after the dot-com boom became obvious, the bust became apparent, 2001, 2002, I don't remember the date. I was at a conference in Dallas, and somebody was bragging that he got a big bonus that year because he outperformed the market. He only lost 32%.
Oh my God.
I think that it's one thing to be operating within a financial world and another thing to be in the financial world. Look, it's sort of like I told someone he asked me to go on a podcast once. I was recently, and I said, "You don't want me on a podcast." I said, "It's like inviting an electrician to a conference of dermatologists. I just don't belong there." So if you step out of the financial world and look at the real economy, the people who actually produce goods, the people who actually allocate capital around the production of goods, the people who are interested in the customer himself, the people who are interested in be remaining relevant in whatever business they're called on. This is what interests me. You know, if you and I were young and you pursued a career in dentistry and I pursued a career in plumbing and we lived next door, we would never really compare ourselves and say, well, you making more money than I do, or you're driving a better car than I do. I chose the career in plumbing and you chose the career in dentistry. In any other business, people do not compare themselves because their means are different, their destination is different. And so when the destination of people is different and the means they employ to get there are different, the important thing is what it is that they contribute to those they serve within the context of their aims. And so to measure everything with money, particularly in light of the fact we don't quite know what money is, it would be sort of stupid, wouldn't it? And so I have met a lot of entrepreneurs in my life. I mean, a lot. I have been to more factories than you can care to think about. And none of these people are concerned with financial markets. None. I've never. So you ask a question, what worries you the most to an entrepreneur? He will never say it's the Federal Reserve Bank or the Bank of European Central Bank or is a monetary policy or is economic fiscal policy. They'll never say that. What concerns them is their people, their economic relevance, their competition, their technical skill set, their ability to survive, their ability to be resilient, the ability to profit and redeploy their capital appropriately. This is what interests them. This is what interests entrepreneurs or business owners. And so it is only in the financial world that we tend to constantly compare ourselves in terms of money without really focusing on the means or the objectives that we have in pursuing whatever it is that we pursue.
Tony, you mentioned the fact that people in the financial services industry tend to be focused on primarily making money rather than necessarily doing other things for the community. But that also gives the question, what is money anyway? And my own suspicion is that just about everybody involved in finance has no clue what money even is. Do you agree with that?
Absolutely. Someone said is money is like time. Everyone knows what time it is, but ask them, what is time? And that's a much more difficult question. No, I mean, this is really true. I mean, we measure something, we build something, and we're using a tool that itself has no yardstick. And you know that as well as I do, if not better.
So as money loses value over time, clearly we have inflation. If inflation is represented by the stock market going higher, why would it be a poor choice to put money in the stock market that should, I'm playing devil's advocate here, but why would it be a poor choice to put money in the stock market?
Yeah, but if the money that is employed is and the result of savings, that's one thing. But if the matter that is employed is a result of new money being created, or borrowings or debt, because today money is debt, right? And debt is money.
Mm-hmm.
And so you have inflation. You've had inflation for a very long time. Inflation is actually a fairly difficult notion to understand, even among economists. But I think that the rise in asset prices is no different than asset in the prices of goods. The question is why are asset prices growing? And if you gave me your credit card and I started borrowing on that, getting cash out of the bank and buying stocks, the economy is going up. But is it really my savings? So understanding the foundational parts of why something is going up and what it means is a little bit more essential to this thing. Now, we go to a supermarket and we see all kinds of goods being produced, being on the shelves, but we don't think of the people who actually produce them. They didn't sit behind a screen. They didn't produce videos of you on YouTube. They had to do. There was a lot of work involved in producing the products that we take for granted. And so there's a misallocation of capital because the money going to the stock market does not really produce more things. There's no new food being created. There's no more capacity being created. There's just more money, and there's higher asset prices. There's no increase in wealth. There's an increase in money that finds itself in these forms. I mean, look at the rise. It's not just the rise of equities market. Is this notion of private equity and all kinds of other things that have come as a result of this stakeholder capitalism idea that has destroyed our society and has destroyed our money and our savings. And so then there are other factors involved. When you bring the interest rate down to zero and you destroy those who've saved in their entire life in order to have something in their retirement, you create a culture of speculation. And you force people really to start thinking about how do they preserve what they have, and about the only thing they know is the stock market. So the stock market is not a very, very good at all measure of the health of an economic system at all, particularly nowadays, and particularly in the United States.
But if you had a groundbreaking technology like what we've seen with, say, Amazon and say Netflix and disruptors of traditional businesses, um, without some form of access to capital, access to the markets to sell shares, um, how could they have created those businesses? And I guess you could say that, well, that's irrelevant perhaps to what you're looking at, but does it not serve that function, which ultimately one could say is a step forward in technology and therefore better for human beings?
No, sure, there's no question about it. There's no question about the role of the capital markets in financing true industry. No question. It's been happening since the beginning when the first stock market was created in Amsterdam, I think. Isn't it true, Tim?
I think it's Holland, yeah.
Yeah. No, these are two different things altogether. I mean, you cannot compare what is happening today with the traditional role of the capital markets that used to be there in capital formation. But today you have no savings. In fact, no one even talks about with the word savings anymore. Um, People borrow money and they call it is their capital to employ as they wish, and their only purpose is to make money and to make money as soon as possible, as fast as possible. Damn the consequences. Now, what has contributed to that? I think it's a philosophical and other a lot of. It's a very interesting question that I'm not sure it belongs in a forum like this, or with platitudes and short descriptions.
There's a question that Paul is going to want to raise, which I'll beat him to the chase on, and that's over the nature and the role of Bitcoin and cryptocurrency more generally. Do you have a view on the social utility of Bitcoin?
Well, Tim, I don't even know what it is. I haven't seen one. I don't know what it is. I don't know how it works. It's not something that I have given any thought to. I understand its price in money is going up every day. And I understand in a few years it's going to be like several $100,000 Bitcoin, but I have no idea what it is any more than I'm interested in exotic African art or anything like that. It's just not something that I find suitable for my needs.
I was Tim forwarded the owner's manual that you have to me,
Uh-huh.
which I read all the way through. I think you could sell that as a book for people to understand a very interesting approach to the markets. And well, I guess within it you say you don't like promotion, but it's such an interesting read. It seems such a shame that more people wouldn't get to see it.
You know, most of everything that could have been written has already been written. I don't see that this has any more would have any more impact on. We wrote it principally for our own shareholders because I think that when you own something in which we have the privilege and responsibility in most of the cases to look for our shareholders that they have the vast bulk of their savings within the company. We're a very small outfit by today's standards, and as a result, when you are in that spoken position, it's very important to explain not the details of what you do, but why you do what you do. What are the factors that are important in your pursuit? And that was the principal motivation behind the writing of this short thing. Now, in the future, maybe it needs to be rewritten in a little bit different context, perhaps. But I'm not. This is not something that I'm pursuing right now. I really, I mean, Paul, I have no great confidence in my own words or skills. I think that Tim does a much better job in describing and elucidating ideas than I ever will.
Well, that's
Well,
very kind, but I just take other people's best ideas and then parrot them.
I'm not trying to flatter you, Tim.
well, I know what you mean about Tim. I feel the same way. But but genuinely, I thought this was a very interesting read, and I think it's the sort of thing that you'd want a younger person to read because it sort of recenters your ideas about how the markets work and what you should look for. How does it work with you deciding to buy a new company or invest in a company compared to what you already have? How do you make that transition of, oh, I've got an opportunity here that I might want to I want to invest in, but I'm also invested here. What makes that shift?
Well, look, I've spoken somewhat in the past about the principle of exclusion. Um, you cannot look at everything in life and try to find something that suits you. You have to, in order to, un, in order to find the kind of thing that is suited to your endeavor, you have to dismiss a whole lot of things to start with. In the end, it may sound simplistic, but I have two or three important considerations. One is that do I understand this business? And the more you understand the business of the business, the more you are capable of understanding the risks you are taking or the risks you're avoiding. Do I understand how it works? Do I understand where the customers are? Do I understand why people buy what it is they buy from them? Do I understand why they're relevant? Do I understand the economics of the business? If I understand this business and I'm comfortable with it, the next question is, do I like this business? Would I want to be involved in this business? Would I want to own this business? Why? There are many businesses that I understand. For example, take the airline business. I truly, truly understand the economics of the airline business, but I don't like it. I don't want to be involved in it. So I don't care how cheap British Airways may be. I am just not interested in it at all, ever.
Why don't you like it? What is it about it?
It's not a business that suits me. It's not a business that for me that has the resilience that I am looking for. It's a business that depends largely on external factors, external forces, whether it's the price of fuel or the cost of money or the geopolitical risks for people traveling or competitive pressures. Is a business easy to get into. It has a great deal of government regulation. It has too many things can go wrong in this business. And you know that. And there are many, many other such businesses. The banking business, for example. I understand fundamentally the economics of the banking business, but I would never be interested in owning shares in a bank. There are too many ways you can cheat. There are too many ways you can obscure the reality in your financial accounts. There's too much government interference in the business. There are too many externalities that contribute to your success or to your failure. I'm just not interested. The high-tech business is another one of those that years ago, I'm talking about before. Well, there was a time when the only people who had networks was a company called Novell. This is in the 80s, late 80s, early 90s. And there was a company, I will not mention its name, who came up with an incredible way to connect computers and make them all work. And it was a very novel thing. And it was an IPO in New York, and it went crazy. And I think the IPO was at 10, and it went to 28 the same day that it opened. And I looked at it and I said, this is a very wonderful business for the future, but it's a bit expensive. So I'm just going to keep it on the list. 3 months later, the shares were down at 7. Well, it just so happens that while they were so excited about having discovered a new thing, some young fellow at MIT discovered a new way to connect computers that literally put them out of business within 3 years.
Wow.
This made a huge impact on me because, look, in order to remain relevant in many of these fields, you have to constantly take money and put it back into making new gizmos. There's a lack of resilience in this business. You don't know. You can look forward 10 years and you don't know. It could be triple the size or it could not be in business any longer. This does not interest me. And so Do I know this business? Do I like this business? Those are two things. And then the fact is that you have to look at the people behind the business, and you have to ask, what is their motivation? Do they own this business? Do they own it because they put on their own capital, or is it because they got options? Are they there for the next 20 years, or are they there for the next 10 years or 5 years? Is there a picture of the CEO in the annual report more than once? Do they spend more time on Wall Street than they spend on the factory floors? A lot of questions like this. I want to understand their motivation. And when I understand it and all is good, then I'm asking myself, what is this thing worth? Paul, let me give you a little sort of analogy that would help you. If you and I were interested in buying a company, let's say a restaurant down the street, as partners, and the restaurant was for sale, we would walk into this restaurant and we would not ask them for their financial accounts, would we? What kind of food do they make? Who goes to eat there? How often they go? How often they're open? What kind of people they are? Is the place clean? What is their reputation? There will be 1,000 questions to ask before we decided that we liked the business. And then when we decided we did, it would be only then that we'll say, okay, where are your accounts? Let's see your tax statements. Let's see who your vendors are. Let's see what your liabilities are. Let's figure out what this thing is worth, after we decided that it was worth buying.
But let's say it was a tea company, and there's this tea around at the moment that my daughter really likes called boba tea, and we went to that similar restaurant or place that was selling this thing, and you and I might not know what this boba tea thing is, but it could be the next big thing, and the accounts might tell us that actually this is something that people are very, very interested in. I'm not saying that we shouldn't also look at all the elements as well, but the fact that people are spending a lot of money on this, and it's something akin to maybe the beginning of Starbucks potentially, would tell you financially that perhaps you're on the right track. And how do you differentiate between something that might not be something that you personally know that much about, in terms of, say, something like this that could become a big opportunity, against, knowing it and saying, okay, I think I'm going to be right here?
Well, yeah, if we were the kind of entrepreneurs that could make sense out of this trend, we could. But you and I would not have that skill. It would require us to guess. And guessing is not something that is as reliable as looking at the past and looking at the present. And so I would avoid guessing in areas in which I had no understanding.
I mean, Buffett, I think, has referred to this as, or Buffett and Munger have referred to this as sticking within their zone or circle of competence, haven't they? That's the phrase they've used.
Oh, indeed. There's no question about that. And then there are other factors, Paul, and the reason I mentioned this restaurant idea to you is that let me give it to you in a different using a different metaphor. Suppose we were art collectors, and that was our business, perhaps to advise people on art, for argument's sake. So the art market, what happens in the art market, it will be of interest to us, but would not be as important because we are only interested in a particular collection, or in a narrow area, and what happens in our narrow area. So if something else, somebody's buying, say, Rembrandt prints, that's great, but I'm only interested in something else, in postmodern paintings or whatever it is. So what other people do is irrelevant. The question is that in order for you to be a great art collector, you must really know what it is you want, and you must be able to value it, so far as value is important to you, and value is always subjective, properly. And so this what makes the difference. This is what is so important. And I'll have to give you also another in this particular case is a very appropriate metaphor. If you're running a business, say making plastic products, and you end up with cash in the bank at the end of the year, you have to decide, do you buy more trucks? Do you add to your capacity? Do you hire more people? Do you put it into marketing, advertising? Do you put it in the bank? Do you get paid as a dividend? How do you deploy your cash, your earnings, so to speak? There's no difference between a proper entrepreneur and an investor in that sense, because you understand the business, you understand its needs. Sometimes you put it in the bank and wait. Sometimes you buy new machinery. Sometimes you buy a new mold. Sometimes you hire new people. Sometimes you hire new scientists or whatever. You establish a new subsidiary overseas. The allocation of capital among business people gives you a lot of clues as to what motivates them, what's important to them. When a business owner makes an investment that will bear fruit in 10 years, 5 years time, you're not going to see it today. Its price on the stock exchange may not reflect what is happening today on the factory floor, because the stock exchange looks at the past. And I think that is extremely important if you have no understanding of the business in which you own. Now, if you're merely speculating on buying 100 shares of stock in order to sell it at a higher price at a later time, we're not talking about you. But if you're an owner of something that has meaning, it has substance, and then you must be concerned with those factors that would allow you to be confident about its resilience and allow you to sleep well at night, because sleeping well at night is more important than eating well.
Have you ever learned so much about a business that you've been able to say to that business, oh, I think you should have a look at this particular process, or have you ever thought about doing X, Y, or Z to improve your profits? Or are those businesses so well tuned that they know so much more than you that you would never feel the need to do that?
Well, I would think it would be rather presumptuous on my part to advise people whom I respect of what they ought to be doing. Sometimes I have a good idea, but most of the time they've already thought of that.
Yeah, that's interesting. I mean, I just meant as a suggestion. I wouldn't expect you to be saying, well, you should be doing this. It might be that you've come up with an idea that through your experience, because they are very skilled in what they're doing in their field, but you're looking at so many different fields that you can kind of join the dots between what maybe another company is doing that they're not doing.
Well, from time to time this has happened, but it's a result of a little conversation rather than a suggestion. You want to be very respectful of people whom you respect. Let's put it this way. But in the course of a conversation, you discuss matters of what ifs and things like that. That's okay, and I think that's oftentimes is welcome, particularly when they know you're not a speculator in their shares. Because a fellow told me once, he says, everybody who comes to our shop to talk to us, he says, analysts and others, they always want to know, why is it that we don't leverage our balance sheet to earn more per share, or why can we do this or can we do that? And the only issue is how come we can do certain things to make the price go up, the price of the shares. Because hardly is anybody's interested in the business of business. And so a lot of these people used to getting questions from Wall Street and financial types that are different from the kind of questions I would be asking. But I think it's rather presumptuous to tell other people how to do certain things. Either you respect and trust their judgment, or you don't.
You mentioned the importance of decisions around capital allocation. Have you ever seen an environment globally as challenging for business owners as the one we're currently in?
No, I have not. And frankly, this is something that's the most significant thing that I see. My colleague Michael Weeks talks about the consequences of consequences. And I'm sure it's not a new idea, but I think that a lot of people who are involved even in industry have been deluded over the last many years by the destruction of money and savings that has taken place, and by the role of government in industry, or the loss of property rights, or many other factors. And of course, what has resulted in all of this largely is a heightened time preference. I was thinking the other day, if you took at random 50 people and magically you gave each 1 billion, say, US dollars or pounds sterling in their bank accounts, how many of them would start a new business with that money versus becoming all family offices and hiring people to help them invest it? Not very many, I suppose. Maybe one or two. We're no longer a culture of production. We're a culture of consumption and thinking about today. We've eaten the seed for tomorrow completely. But, look, there have been difficult times in the past, Tim, many, and even worse. But we've never had this universal, more or less global, well, I should exclude parts of Asia, I suppose, and parts of the world, but at least in the Western world, we've never had such a disintegration in every respect as we face today. And I'm not sure what impact that has long term on many of the things we take for granted.
Do you see the Trump 2.0 administration as doing anything that can change that environment for the better?
Well, as compared to the alternative that could have been in America, yes. But in absolute terms, I don't think so.
Mm.
What do you think will be the end result of this mismanagement of the markets, of the way governments continue to inflate away debt, to print money? Where do you think we're heading to? And is it possible to see that tipping point where the financial system could potentially not recover as it did in 2008?
Would you guys have anticipated what is happening in the UK today, once an extraordinary country, or Germany, or France, or Canada, or name it?
I mean,
none of us would have anticipated that. If you, I'm really not an expert in these matters, and I certainly don't want to say anything that, but if you think of the period of the 1930s, if you study the 1930s as a period, and the kinds of things that contributed in the interwar period, this is quite similar. I'm not sure what it will be, but I think that impoverishment is an ongoing affair. We might be seeing a lot of money and a lot of progress, but realistically, the vast bulk of people are being impoverished today. The middle class has been destroyed in the Western world. Or the alternative will be war.
It seems today that people are having fewer children, and that is something that hasn't really come up on the radar as to being a financial problem. But at some stage, if you don't have people, you don't have an economy, you don't have a market, and every advanced economy is seeing a decline in birth rates, and that's happening for the reasons that you're saying, because it's virtually impossible for people these days to start a family because they can't afford to do it. Eventually, that is going to be that's a problem that virtually every economy is facing. It's not apparent right now. I think South Korea is the worst country for it, and they've got a high concentration of certain businesses that Samsung, for example, that require a younger population to come in, and they're having to look at immigration to sort that problem out. But if all these economies are, because of the reasons that you've said, effectively destroying the value of money and having a deceitful kind of financial system, the illusion that we're all becoming wealthier is one that's actually not hidden by the fact that people can't have children or choosing not to have children because they simply can't afford to do so.
Is this the only reason?
Well, I would say it's probably the biggest reason.
I mean, what you say is true. It's true in the Western world for sure. But my friend Tim would not disagree if I were to say that a lot of this has come as a result of the destruction of society, but because of the destruction of money. It's no secret that our parents, with one income in the family, were able to support an entire family. It's no secret at all. In fact, most of them were able to save money. In fact, all of them did. Because our parents came out of my parents came out of the war. It's no secret that money has been destroyed. And at the same time, as a result of that, we have a heightened time preference. No one is willing to make an investment today that will bear fruit in their children's lifetime. No one cares. At the same time, we own more material things than our parents did. How do you reconcile these two? We have things today that our parents never dreamed of having, whether it's an iPhone or whether it's a computer or a much better washer and dryer, et cetera, et cetera. I think these are consequences that are they're problems that are intractable and they cannot be solved merely by having more money. Having more money does not mean you have more wealth. And this is something most people don't really quite understand. You need to produce more. You need it's we've turned society on its head. I'm not sure how you reverse this outside of failure. It's only a complete failure of something that is going to bring about a rejuvenation in ideas that matter. So the question is that when there's a fire someplace and everything is destroyed, what is it that it remains that has value? And this is really what I'm interested in.
Taleb was saying that he made a lot of what Taleb says and has written has been very interesting, perhaps not so recently, but in the past his books have been game-changing, I would say. And one of the things he talks about is effectively the Lindy Effect, which is the longer something survives, the longer it should survive, which I think is a parallel to perhaps how you look at businesses. The longer the business has been there, the longer it will potentially be there. Is that correct? Is that something that you look for when you're investing in a company? And how would you spot changes that might even bring down a company that say 250 years old and has never done anything different before, but suddenly might do something that is outside of what they've done before as a warning sign for you to get out? Are there things that can happen like that?
Well, this Lindy effect is theoretically is correct, but if you think of companies like Corona Smith typewriters or Olivetti or a bunch of other such things that have been around forever, and all of a sudden they went out of business. I don't think in practice this Lindy effect, in my view, of course, and I'm not as smart as Nicholas Taleb is, but in my view, something that works in theory is not necessarily work in practice. I think you need to have a culture that thinks about tomorrow and the next 5, 10, 15, 20 years. It is only then that you're able to make the kind of decisions that are wise. if you think about next quarter and if you think about next year, to please your banks or to your investment bankers or your those who rent your common stock for whatever period it is that they rent it for, you are going to make the kind of errors that will put you out of business sooner, regardless how long you've been in business. I mean, look at companies like General Electric, once an extraordinary company, but they became a financial organization at some point, and they made more money from financing things that they made from making light bulbs or whatever else they make. And the company has become irrelevant, really. Look at IBM, look at many, many, many others. The cemeteries, business cemeteries, are full of once extraordinary companies that have been around for a long time. And so history does matter, but at the same time, those who currently run the company, their understanding and of what's important is perhaps a little bit more important. I don't. I've never really paid much attention to Lindy Effect, but I did like his work on the Skin in the Game, the book that he wrote. That's an extraordinary book, by the way.
Yeah. And Anti-Fragile, I particularly liked.
Exactly. Yes. Exactly. Exactly. Now it's difficult to um, it's difficult to understand these things in a potential investment if you're just merely looking at superficial metrics, um, particularly in financial accounts, to see that distinction. You really have to know the business. You have to know the people.
Maybe I've heard this from Buffett as well. If he wants to buy a business, effectively, you want to buy all of it.
Well, to the extent that you find it valuable to own 1,000 shares, um, it is important that your decision to buy 1,000 shares would not have been different if the whole company were available and you could buy the entire thing. Yes. Yeah, it's something that it must be desirable for a particular thing. Now, every investment you have does not have to have the same role. I don't believe in formulas, or I don't believe in the idea of having um, a scientific, a scientific checklist of everything has to fit a particular situation. In essence, when you are an owner of investments, you have a collection of assets, each one of which serves a particular purpose towards the whole.
So if you liked a company and you'd met the owners and all the things that you would look for seemed to check out, how would you know whether you were at that point overpaying for the company or getting it at a really good price? What would tell you that it's time to buy?
Well, I don't know.
Brilliantly
I don't
honest.
know. I'll tell you a little story. Back in 2001, I think I was in a conference in Brussels, and a guy sitting next to me at the table, one of these round tables, so people are around. It was a young analyst from a bank in Brussels, and he says, "Have you heard of Lotus Bakeries?" And I said, "No." He says, "Their company just listed a few of their shares to raise some money to expand their factory." So what do they do? Is they make cookies. I said, "Wow." So I looked it up real fast and I called them up and I said, "My name is Tony Deden and I'm in Brussels. You're not far away. Could I drop by and say hello?" And they said, "Welcome." And so I went to see them and I was fascinated with this business. They made cookies, but I loved their culture. I loved their business. I loved their product. Everything about them was just extraordinary, except that the shares were selling at 58 times trailing earnings and 20 times book value and all those other metrics that you will just squirm if you saw them. But it was only 30 euro per share. So I said to myself, I love this business. These people are incredible. I love what they do, but it's too expensive. I'll look at it next year. I'll put it on a little list. And next year it was selling for 80 and it was still very expensive. I waited. And next year it was selling for 150 and 300. 10 years later it was selling for 2,000. Still very expensive. And at some point, it went to 2,800 uh, euro per share. And I looked back and I said, what is it that I missed? What did I not see? There must have been some sort of factor that I did not see in here. Why is a company that is, the family owned 90% of the shares or 85%, something like that? I don't know, a very little float, but very expensive. Um, and all of a sudden I understood that invisible bit that it was difficult. It would have been a difficult thing to see. And don't ask me what it is because it would vary from a business to a business. And then when the company decided that they're going to scrap the dividend so they can raise money to finance their expansion in the United States, the shares went from $2,800 to 2,000 euro, not dollars, euro. And I bought my first shares in that company at 2,000 euro per share. Now, I could have bought it for 30. Now it's selling today for roughly 11,000 euro per share. The same company that 22 years ago was selling for 30. Now, granted, is a bit rich, to say the least. And, and I've let some of the shares go. But the point is that you are looking at invisible aspects of what something may be worth that you cannot always put in a nice, neat formula. And where I think I have failed oftentimes, both on the decision to do something or not to do something, is on relying too much on financial metrics. And I think those are very useful. There's no question about it. But they do not lend themselves as much as one would think to the idea of what something is worth to me. And remember, Paul, the idea of financial accounts, when accounting was first established, was never meant to be a tool for valuation. It was meant to be a tool for accountability to the owners of companies.
No, I didn't know
Yes.
that. That's really
And it's
interesting.
only in the last 50, 60, 70 years, I think, that we have taken financial accounts, the balance sheet and the income statement and cash flows, and made a science out of it and created an entire framework of rules and processes by which we can judge the value of something, particularly by guessing its potential future returns.
We haven't yet. We've talked about money. We haven't talked about gold. Do you have any strong feelings about the likely direction of the gold price this year?
No, nope. It could go up. It could go down. No, Tim, I don't. I never had any strong. You know very well that I bought the first gold in 2001. I'm sorry, 2002. And, I've owned a lot of it over the years. But I never saw it as an investment. I've explained very diligently exactly why it is that we own it. But it ends up having been the very best investment I've ever made over the last 20 years, if you think it overall. I've been accused of owning too much by many who thought that I could take the money and put it somewhere else. I've been accused by others of having too little. But knowing precisely what the price of it in money is going to be next year or a month from now, or all I can say is with some confidence is that in terms of money, the price of gold in money is going to be substantially higher sometime in the future.
There are three characteristics that I think you've highlighted to me in the past of a successful investment, or what is likely to be a successful investment. And those three characteristics are independence, scarcity, and permanence. I think it would be fair to say that gold neatly addresses all of those in a way that traditional money doesn't, or what currently money doesn't.
Yeah. Now, all of these three factors, I think that all these three factors quite essential to the whole. And to the extent that you can find something that has all of the three put together, that's worthwhile. And so I think that there are many people who suggest that there's going to be a bust on the stock exchange. I don't know. It could happen. It could not happen. I don't really know. I cannot tell. There are some people who are accumulating cash, fearful of what may be coming. There are other people who buy treasury bills or bonds or whatever it is. I think there's a fellow I've known for years. He's a very responsible fund manager, and I would say 40% of his assets are in medium-term bonds. Uh, Now, if you tell him that perhaps he may want to rethink this, he's very convinced this is a very good way to preserve his capital. I don't think so. Neither do you, I suppose.
Mm.
But on the other hand, I think that the idea of independence from the outside, any element outside that, the external element that you can find that will be impeding your own ability to choose and act, that's a wonderful thing. Scarcity, of course, is self-explanatory. But what makes something scarce is not necessarily make it valuable.
Mm.
No?
Sure.
Tim, perhaps from your perspective, knowing what Tony does, what are the differences between you?
That's an interesting and intriguing question, and I think only our mothers could tell us apart. Our use of systematic trend following funds is probably something that might be an asset type or a vehicle too far for Tony. And it's not a criticism of either him or myself or ourselves, but we would regard that as just an extra portfolio diversifier. But I suspect it might not pass Tony's smell test.
I don't even know what it is, so I'm happy for you. I don't know what trend following is. How do you do that?
I'll let Paul.
Okay, never mind.
Opine a little on this if he wants to.
I hope maybe you call me later and explain it to me. Maybe it's something extraordinary.
Well, I can explain it. I can explain it very simply. What it is you look at a range of markets and you say, I don't know where any of these are going, but over time, at some point, they're going to trend. And so using specific trading parameters, you try to capture a trend in one of those markets, and you're just watching the markets to see when one will trend. Now, it could be that stocks trend up, it could be that bonds trend down, it could be that gold goes up, it could be that hogs collapse, it could be that coffee goes up. But over time, everything will trend. And there are periods when the markets are very trendy, to use that expression, and trend following funds will make a lot of money. And there are periods when they won't make very much money because the markets don't trend. But it's not something that you look at the market and go, oh, I think I'm going to buy it now. These are pre-programmed risk, in terms of risk management, in terms of position size, in terms of how you enter and exit. It's all rule-based. So there's no human interaction other than just expecting the markets, a range of markets, to at some point move in a very aggressive way in one or other direction. What's also useful about trend following is that it tends to be inversely correlated to the stock market. So if there is a crash, trend following funds will tend to do very well because everything will move very aggressively and, inverted commas, trend at the same time. And this system of capturing the moves, purely based on just price movements, will tend to make a lot of money in those periods. So in a similar way, over the long term, trend following works. In another similar way to value investing, there are long periods of time when it doesn't. And that's why not many people can stay with it, because you can end up with quite big drawdowns of capital over capital ebbing away over a number of years, and people then just go, well, why am I doing this? And they exit. But eventually the system will kick in, and it usually kicks in at the right time. And to have it as a hedge against a value investing portfolio, which is a completely different type of discipline, is a very interesting and unique approach. Now, I'm personally I love the idea of value investing, and I truly think that, when you see the masters of it, such as you and Tim, it becomes very compelling. Trend following, to me, makes more sense, and you've got to do what works for you.
I mean, the fact that I don't understand it does not mean it's not valid. I take my hat off to you for having found a new way to skin the cat, but I couldn't help it. But as you were talking, I was thinking about sitting in a room full of slot machines and watching which one pays off how often, and making a guess as to which one will pay off next. So I mean, that's okay. There's nothing wrong with that if you have found some meaningful way that rationally you can anticipate adding to your net worth by dabbling in it. That's fine. There's nothing. Many different people do things in a different way, and I don't think we can compare the value of this versus something else. It depends on your aims, it depends on your temperament, and it depends on who you are, and if you can sleep well at night, and if you're happy with what you do, and how much you allocate to this and that. That's okay. There's nothing wrong with it. As to value investing, I don't quite know what it is, even though it's a very common phrase that is being used rather extensively in today's world. I've seen too many idiotic things take place in the name of value investing, and everyone's quoting Buffett, but no one really does what he does. So we need to be very careful about these words that we use, because you cannot define value in terms of metrics. Value is not quantifiable.
I forget who it was that said it, but I think the American giants of fund management said that all successful investing is value investing. I think they come close to the idea.
Well, exactly, because value is subjective. All value is subjective. There's no objective value. We all get to choose what is important to us and why it's important to us and to what measure it's important to us. And one of the things that has contributed to many people's progress is the idea of interpreting value in the context of what's valuable to them, what they consider to be valuable, despite of the various metrics and other such things that may exist over there. All I'm against is mechanization and the making mathematical formulas out of the notion of value. I think that's just complete malarkey.
If money was backed by gold, would you be happy to hold cash, or would you always want to go to the source of gold itself or silver?
Well, money doesn't have to be gold. It could be anything else that is that has value in itself, independent of the state. So I don't believe in a money monopoly. There's no reason why you live in the UK that you are required to use British sterling and pay your employees in pound sterling, or I'm required to pay people in Swiss francs where I live, or something else. I believe that money should be independent of the state, and it should have substance of its own. And so would I want to do that? Look, business value has nothing to do with money, in the sense that what has substance will survive money. So 10, 15 years from now, whatever it is I own, no matter what money is then at that time, it will be valued properly, however it's measured. So how we measure something has nothing to do with its basic nature.
You've referred to the state and the growing size of the state. Are you at all hopeful that within our lifetimes we may see a reduction in the size of government in the West?
I doubt it.
But isn't that good? Because you've referred to, I think, let's say something akin to systemic failure.
The state
Surely
is like
that could be one trigger for that, perhaps.
it's a monopoly of power and coercion. I don't think this is going to happen in our lifetimes, Tim.
Mm.
I don't think so. It's not in the nature of man. You know, the idea of personal freedom, and there's no. We've never really had free markets in the sense that people think about people think about capitalism. We've never really had proper capitalism in the sense that it should be. We never had free markets. There's always been interference from the state. But now, on top of that, you have destruction of private property, private contract, freedom to speak, freedom to act. If you and I decide that I could give you my life savings to look after, and we are happy with the contract we have between us, that's not good enough for this. The state is involved now. The state has to uh, tell you how you should run your business and interfere in the contract between us in many different ways, and mostly in ways that really prohibit you from doing what you think is the right thing to do, and you know that.
You're based in Switzerland. That presumably hasn't happened entirely by accident.
It's probably one of the worst places you can be in terms of regulation.
But what I'm getting at, I'm trying to remember the name of the guy who wrote it, but I think it was the collapse of nations or something like that. But he talked about I think it was written shortly after the war, but he talked about the fact that people would be so much better under a system like the sort of cantonization of Switzerland rather than having these giant Leviathan states.
Yes. Well, yes, because really, my connection with government here is at the very local level in the village that I live. There's no other, I have no interest. The central government has a very small part in the daily lives of people. So that, and also, you have here direct democracy, not representative democracy, which is an entirely different animal. And so it works better also because of, then the cultural framework and the institutional framework of society and the historical antecedents that put it, that actually bring it together. It's not an accident, but it's not perfect, as you can imagine, but it's better than other places. Let's put it that way.
So in terms of legacy, will you look to mentor someone in the ways that you have invested and analyzed the markets? How does your knowledge get passed on?
I have no particular dreams as to legacy. I think that if you live your life well and you have the respect of your friends and the love of those around you, and you've said you've done the right thing and the way God gave you the light to see what was right, you've lived a good life. And there's no reason. I think that it's ideas that matter, not people. I've learned from others. Others may learn from me. I don't know. I have no notion of having anything to pass on. I think that I think it's important to have a realistic sense of the value of one's ideas, and I'm not sure it's necessary for me to have such objectives.
I meant in the sense that you learned from a mentor, and there must be lots of people who want to learn from you directly, and whether you'd ever been approached, and obviously you run a firm with people who are like-minded towards you, but in the same way that, say, Warren Buffett wrote his books, would you ever be considering writing actually, as I say it, I realize the problems of how writing one of these books would present a problem, because how do you can't describe a lot of the things that you do in words anyway.
Well, I leave it to Tim to write books, and he's written two that I know that are very good. And perhaps someday he and I might be in a old people's home together, and we can combine our resources and write a new one.
Well, I'm trying to encourage Tim to write a book on value investing, but he very modestly says that it's already out there. But I always think individual perspective is what people are looking for. And as we both know, his writing style is so engaging, and I would love to see a book like that. But I totally understand.
I look, I'm not so sure that the business of deploying your capital is something that anybody could do just because they want to, or because they're intelligent and smart and they have a medical degree or whatever it is they do. I think it's a matter of common sense and temperament more than it is one of knowledge and intellect. Um, uh, and because the financial business tends to be extremely rewarding in terms of return on capital to those who are participating in it, it attracts a lot of people. And yes, we have been approached by a number of people over the many years who want to either work here or want to be mentored or whatever. And in the end, after a short conversation, you come to conclude that really most of them are interested in making money. That's it. And so I tell, if a young person were to ask me such a question, I'd tell them to go work in the industry for a while, maybe 10 years, get an engineering degree, work at a factory somewhere, learn some important issues, and then perhaps slowly he can. I think that the idea that the investment world has become a business, when Tim was younger, and so was I, for example, we were practicing we saw this as a practice, not as a business. And I still don't think Tim's work is a business, otherwise it would have been 10 times larger. It's a practice where you take your whatever knowledge you have, whatever skills you have, and whatever time you have, and devote it in the interests of those you serve. Period. Period. Now, if you're interested in maximizing your own income, maybe Tim will put together a hedge fund. Or I had many opportunities to do that, and I've said no. So the point is, once you have what you need, the pursuit of money is no longer the interesting thing. The pursuit of doing the right thing is.
We had a recent guest on, Jonathan Brown, who's a performance coach, and I think he would agree with the idea that there are multiple ways, as I think you've already said in the last hour, that you can go about skinning the cat. But what's important is to find one that suits you mentally, psychologically, and that enables you to sleep well at night. So that I'd say is what the objective should be for most investors, which is whether they're doing it themselves or whether they're trying to seek a manager to do it on their behalf. It's finding an approach that matches your psychology.
Exactly, but also notwithstanding understanding the trends and the environment in which we live. But no, it's not that the world back in the 1980s was any better than it is today. But today you don't trust anything. I mean, I don't trust the Wall Street Journal. I don't trust the Financial Times. I don't trust the government statistics. I don't trust anything that comes out of any officialdom. I don't trust most corporations. And so when you have a complete loss of trust, I don't trust audited accounts. Every fraud out there had an audited account.
Do you have your own official inflation figures and things like that?
Of course not. Of course not. It's a waste of time. What's the point? The thing is that when there's this loss of trust, and now you're on your own, and you can never have progress in a society without trust. Trust is a glue that holds societies together. And so this is what we have. So, Tim, you have any other thoughts?
I think we move to media picks, Paul.
I think we do. I was just going to say that the phrase that kind of sums up both what Tim and Tony does is one that I've seen you use, Tim, is you're asset managers, not asset gatherers. So you're looking to manage money as though you own the businesses not just to gather as much capital as an investment as you possibly can, which is what the game of Wall Street seems to be. It's two very, very different approaches.
In my case, if you invested $100 billion in Edelweiss Holdings, I will not make one extra penny. Yeah,
really?
Because we don't have management fees, we only have fixed costs.
Wow.
So, but anyway, yes, there's a difference between an investment practice and an investment business. In a business, you seek to do what the customer wants. A practice is in which you do the right thing by the customer, regardless of what he wants or what he thinks he needs. You seek to do the right thing. And that's very difficult, actually. It's not very popular. It's maybe what he needs, but not maybe what is popular. The fact is that what Tim does and what I do is not really in mainstream desirability in today's world among people with money in their pocket at all. And certainly I would not do it for institutions and such people. I only work for families, for individuals.
So if somebody wanted to approach you, what should they do?
Well, I mean, we are not against having new shareholders. We have once a year, we have a new one come in. We have very few. We don't have an offering memorandum, for example. And we don't have an investment policy. We have an investment objective, but not a policy. We have no, we're self-managed. There are no third party involved. And our shareholders have no right to redemption because we're a holding company. It's just like a private company. So our board has liquidity policies in place to buy back shares from shareholders, but that has nothing to do with shareholders' right to be redeemed. And so occasionally somebody comes or calls and says, I'm interested in what you do. And well, we have a brief discussion with them. And if they're suitable, if we like them, if they like us, if they're for the right reasons, we will open our doors to them. But it's not something that happens every day. You know, Paul, is not unlike you having a party at your house. It's not because you hate anyone, but you don't invite everyone to come because they have money in their pocket. You invite people you like, you enjoy, you love being part of their lives, and it's not that you don't like people. It's just that you're very picky about opening your door to the whole world. The problem, I think, the problem with money today is the problem with the financial field is that if you are a financial practitioner, anybody with money in their pocket is potentially your customer. This is not true in, say, selling automobiles or anything else. You have to be the person wanting to participate in what you do must be going in the same destination you are. You must like who they are. It's more of a personal thing than it is a business. And so we're not against it. We're not against having new shareholders, but they have to be people that we like, or people who understand what we do, people who appreciate it, people who've earned their own wealth. They've made errors. They understand how the world works, and they have the same time preference that we do. And so if you think of it as being picky, so be it, but it isn't.
No, I totally understand where you're coming from. I think the party analogy is an absolutely brilliant one because you wouldn't want anyone just coming in your house. But yeah, that's fantastic. I think I've also heard you mention it in the same way as you're like the captain of a cruise ship, and you're trusted with the direction that the destination that you're going to, and the people that come along are like passengers, and therefore they understand that it will take some time, but they trust that the destination is where you all want to be. So you're all in the same sort of literally in the same boat.
And if you see other ships going in a different direction, you don't just go there because there are more ships going there. You just keep going where you're going.
Yeah. You might see a speedboat going past, you let him go.
I didn't think of that. It's true.
That's Tony, it's been absolutely fantastic. And Tim, was there any final questions that you want to ask?
Nothing to add.
I don't believe that.
Nothing to add today.
Today.
Tim, should I send greetings to your friends in Davos?
Tony, we like to finish up with what we call media picks.
Well, I don't know, Paul. I don't watch much any television, and occasionally I see a movie for entertainment purposes only. I recently saw Whiplash.
Fantastic film.
Yeah, and my wife thought it was rather dark. I thought it was incredibly interesting. But as far as books are concerned, I guess I recommending something would not be something that I would do. I can tell you that my own reading is very different from, has nothing to do with my day job. But I do recommend Guido Hülsmann's Abundance, Generosity, and the State. And Tim and Paul, if you don't have one, I will be happy to send you a signed copy by the author.
Wow.
It's the most remarkable book because it was written last year. Most remarkable. And the world would not see its value in the next generation or two, but ultimately it will. But I'm really fascinated with ideas. I don't know if you know a fellow named Edward Fesser, who's a philosopher, an American philosopher. Some years ago, I read his book called Aristotle's Revenge, where he sought to relate the metaphysical foundations to the ideas of science and mathematics. And that led me to another book that he wrote, was The Last Superstition. And that led me to Mises's famous, small but not very well known book, The Theory of History, which I read last spring, and which led me to this incredible man named Arnold Toynbee, a famous British historian who wrote this 10-volume history, the study of history, particularly in the sense of the rise and fall of civilizations, particularly the disintegration of civilizations. And it's too much to read, but there was a man named, I guess he may be still alive. His name is Somerville, who wrote a 2-volume abridged summary of Toynbee's work. It's called Theory of History, and when that led me more recently to Julius Benda. You know who he is, Tim? Julius Benda was a French intellectual who lived in the early part of the 20th century, and he wrote this book called The Treason of the Intellectuals in 1927. And if you read this book, he describes at the time, among intellectuals, they abandoned the pursuit of truth to serve political causes and agendas and partisanship. And that ultimately contributed to the political and moral disintegration that led into another war and another downturn, etc. So these are the things that I read for fun. I don't really read Warren Buffett or things like that.
Great stuff.
But if I would recommend something, you asked me to recommend. I think that the time in which we live is very dangerous. It's probably the most difficult time that we have. In the course of time, a person's life is a very tiny part, 60, 70, 80, 90 years, whatever it is. But Solzhenitsyn wrote this famous book, The Gulag Archipelago. And of course, it's a story, and the themes are systematic repression and moral degradation. but but more than anything else, it's a story of how ideology can be used in justifying tyranny, um, and the dangers of totalitarianism. So, if anybody wanted to know the consequences of consequences, the Gulag Archipelago may be a very, very good book.
I don't know if you've seen the film Jiro Dreams of Sushi. But
yes, it's lovely, lovely film.
But Tony, I would highly recommend you watch it because I think it would.
I have seen it.
Oh, you have seen it? Oh, fantastic!
It's a very, very good book. It's not about sushi.
Exactly. It kind of marries with your ideas of what makes a business and what makes a business endure, and that's why I wanted to recommend that. But I did steal it off Tim, so Tim, that was yours. But I just thought it was really apt. I find it intoxicating when whatever subject somebody's interested in, that they devote their lives to it, to making it better. So, for example, one of the sports people that I admire highly is Ayrton Senna, who came from a very rich background, but yet wanted to devote his life to motor racing and being the best, and he was the best. And it was just his incredible pursuit. After every race, he would be the last person to leave. He would be talking to the engineers the whole time. That's the sort of thing you can't buy. It wasn't money. There was nothing to do with money. It was everything to do with just being the best. And I always think about that when it comes to doing anything, whether it's markets or whatever. You can't be interested in motor racing for the glamour, for the money. You've got to be interested in it because you want to be the best. Otherwise, it's just not going to work. And it applies to so many other areas. And when you see it, it's truly a beautiful thing. Tim, what was yours?
I haven't got any that are quite as uplifting as Tony's. Mine is mine is a somewhat dispiriting film called White Boy, which was made in 2017. If you like true crime, then this is right up your Strasse.
Okay.
It's a true life story about a guy called Richard Wershey Jr., who was, and I'm just reading the synopsis from Wikipedia. He was 14 years old when he started being groomed as an FBI informant and then established as a drug dealer during the crack epidemic in Detroit.
Wow.
And basically the film exists because when the film was made in 2017, he was still in jail. He was given a life sentence for dealing in cocaine in 88. And I think he was basically the longest serving prisoner of his type anywhere in America. And the more you see of this story, the more you will despise Detroit police, the FBI, Detroit politicians, and sort of by extension, you wonder whether this is just like a sort of the whole world in microcosm. I guess the reason I suppose firstly the whole thing is outrageous, but what it reminded me of was the sort of the intellectual journey that I've been on, which is in 2008 when the financial system came close to collapse. I naively thought that big finance was somehow different and that most things were more or less honest. It then took me the next 15 or however many years it's been to appreciate that actually big everything is equally evil, and that's been a tough pill to swallow. But White Boy is a sort of a true life example of this, and you can only watch it and get outraged by it. It's called White Boy, directed by a guy called Sean Reck. Came out in 2017. I think we saw it on Netflix. But if you were easily outraged, it's perfect entertainment for you.
I will find it and I will watch it.
Thank you, Tim.
But it is not uplifting.
Okay.
Okay.
We got the
and
one.
Tim, next time we chat, remind me to tell you about my recent trip to Russia.
Often, I'd love to hear that.
I was in Moscow for a week 2 weeks ago. So.
Fantastic. If people want to get in touch, Tony, do you wish to share any contact information for people?
Well, we don't have anything public, but if they're right, I'm happy to have correspondence with anybody who wishes to have. My address is AD, that's Alpha Delta at edelweissholdings.com. So I'm happy to have correspondence with anyone who wishes, but it's not secret. I don't have I'm not on Twitter or any other social media, Tim. So there's really nothing else that I have to give.
Okay, we'll put your email in the show notes for people who may want to contact you. But
All right.
but it's
I enjoyed chatting with you. We just merely skimmed the surface of important ideas.
Absolutely. It'd be lovely to do this again, and hopefully one day in person as well, if that's possible. But
as you wish.
Thank you so much, Tony. Really
enjoyed
appreciate it. Thank you.
Thanks, Tony.
Oh, thank you, Tim.
Thanks, everybody. This podcast is for entertainment purposes only. Please do your own research or contact a professional advisor.